There's a video circulating right now with millions of views telling you the global wealth shift has already started. It walks through Rome, the Dutch Empire, the British pound, and maps the United States onto the same pattern. The conclusion? The dollar is following an inevitable historical cycle, and you need to buy gold now or get left behind. Here's the thing, some of that analysis is actually correct, and some of it is dangerously oversimplified. Today, I'm going to do something different. I'm going to break down what that narrative gets right, what it gets wrong, and most importantly, give you an actual framework for thinking about this yourself. Because the goal isn't to tell you what to believe, it's to show you how to evaluate these claims so you can make your own decisions. Let's get into it. First, let me acknowledge what the wealth shift narrative gets right. There is a historical pattern. Reserve currencies do transition over time. The Dutch guilder gave way to the British pound. The pound gave way to the dollar. This is documented history. And yes, the US debt situation is structurally different than it was 30 years ago. That's not fear-mongering, that's just math. $34 trillion in debt. Interest payments now exceeding military spending. These are real numbers. So if you've watched those videos and thought, this seems concerning, your instincts aren't wrong. But here's where we need to slow down, because there's a difference between this pattern exists and this pattern will unfold exactly the same way on the same timeline with the same outcome. And that difference is where most analysis falls apart. Let me show you what I mean. The standard narrative gives you three historical examples: Rome, Dutch Republic, British Empire. All three support the conclusion. All three collapsed after debt expansion and currency debasement. But what about the examples that don't fit the pattern? Let me give you three. Counterexample. 1. Japan. Japan has had the highest debt to GDP ratio in the developed world for over 20 years. By the inevitable collapse logic, Japan should have experienced hyperinflation, currency collapse, or economic meltdown years ago. It hasn't. The yen has fluctuated, yes, but Japan remains the world's third largest economy. No collapse, no wealth transfer to rival powers. Why? Because Japan's debt is overwhelmingly held domestically. Japanese citizens and institutions hold Japanese government bonds. This changes the dynamic entirely. The US debt situation is different, more foreign held. But the point stands, debt to GDP alone doesn't predict collapse. Counterexample 2. The dollar. Since 1971. Here's something the dollar collapse videos never mention. The gold window closed in 1971. That was 54 years ago. For 54 years, analysts have been predicting imminent dollar collapse. Entire careers have been built on this prediction. And yet, the dollar's share of global reserves has declined from about 85% to about 58%. That's significant. But it's not collapse, it's gradual multi-decade erosion. The question isn't whether decline is happening. It's whether that decline is linear, accelerating, or potentially reversible. Those are three very different scenarios. Counterexample 3. The euro didn't replace the dollar. In 1999, the euro launched. Many analysts predicted it would challenge or replace dollar dominance within a decade or two. The euro now represents about 20% of global reserves. Not 5%, but not 50% either. The inevitable replacement didn't happen. Not because the euro failed, but because reserve currency transitions are messier, slower, and less predictable than clean historical narratives suggest. So what's the takeaway? The pattern exists, but the pattern has exceptions. And when someone tells you something is inevitable while ignoring the exceptions, that's not analysis. That's salesmanship. Now, let's talk about something most of these videos skip entirely. The actual mechanism, the part that requires thinking, not just reacting. Why do reserve currencies transition? What actually causes a system this massive to shift? It's not magic. It's not karma. It's not a mystical cycle repeating itself like some financial astrology. There are specific, observable, repeatable factors. And once you understand them, you stop reacting emotionally and start analyzing structurally. Factor 1. Debt servicing costs. When interest payments consume an increasing share of government revenue, two things happen, and neither is painless. Either taxes rise, which slows economic growth by reducing disposable income and business expansion, or more money is created, which dilutes purchasing power and quietly transfers wealth away from holders of that currency. In reality, governments often do some combination of both. The US is currently in a situation where debt servicing costs are rising faster than revenue growth, not temporarily, structurally. That means even if nothing breaks, pressure keeps building in the system. That's not opinion. That's math. And math doesn't negotiate, it compounds. But unsustainable trajectory doesn't mean collapse next year. It means the current path cannot continue indefinitely without adjustment. Something has to change eventually. The only question is how, and how smoothly. Factor 2, the Triffin dilemma. This is something almost no popular content explains, but it's one of the most important concepts in global finance. The Triffin dilemma, named after economist Robert Triffin, describes a fundamental tension at the heart of any reserve currency system. For the dollar to function as the world's reserve currency, the U.S. must supply dollars to the global economy. That means running trade deficits, sending more dollars out than come in. Those dollars become global liquidity. They grease the wheels of international trade. But here's the contradiction. Running persistent deficits eventually undermines confidence in the currency itself. So the very thing that makes the dollar dominant, its global availability, is also what slowly weakens its foundation over time. It's a built-in paradox, a system-level trade-off. This isn't a flaw in U.S. policy. It's not mismanagement. It's a structural feature of any reserve currency system in history. This is why transitions happen. Not because empires are careless or incompetent, but because the math eventually stops working efficiently for whoever holds that reserve position. Factor 3. Alternative infrastructure. Now here's what's actually new in the current cycle, and why this moment matters more than past transitions. China and other nations are actively building alternative financial infrastructure. Payment systems like CAPS, digital currency experiments like the digital yuan, and broader discussions around BRICS settlement systems. These are early stage, imperfect, and in many cases inefficient compared to existing systems. But that's not the point. The point is, they exist. In previous transitions, alternatives didn't exist at scale. You couldn't opt out of the pound system in the early 20th century, even if you wanted to. There was no parallel system to move into. Today, there is at least an attempt to build one. It's fragmented, it's incomplete. It has trust issues and political risks, but it's real infrastructure, and infrastructure changes behavior over time. This is the genuine new variable in the equation. Not hype, not headlines, actual structural change. Okay, so where does this leave us? Instead of predictions, which are usually wrong, let me give you something far more valuable. A framework, 3 scenarios, and more importantly, how to recognize which one is unfolding in real time. Scenario 1, managed decline, most likely. In this scenario, the dollar doesn't collapse, it evolves. Its share of global reserves continues declining gradually, from around 58% toward maybe 45-50% over the next 10-15 years. The US remains the largest, or one of the largest economies. The dollar remains the primary reserve currency, but instead of being unchallenged, it becomes first among equals. Still dominant, but no longer alone at the top. This is already happening quietly in the background. It's not dramatic. It doesn't trigger panic, which is exactly why most people ignore it. But slow shifts are often the most powerful ones. Trigger signals. For scenario 1, dollar share of reserves declines steadily by 1 to 2% annually. BRICS alternatives remain fragmented, political, and limited. In adoption, U.S. Treasury auctions continue functioning without major stress. Inflation remains elevated but controlled, not spiraling. Scenario 2, accelerated transition. This is the scenario most viral videos are built around. Here, a catalyzing event compresses time, a geopolitical crisis, a U.S. fiscal shock, or coordinated de-dollarization efforts that move beyond rhetoric into action. The transition that would normally take 10-15 years happens in 5-7. The system doesn't collapse, but it shifts faster than expected, creating volatility and uncertainty. This scenario is possible. It's not irrational, but it requires specific triggers, not just narratives. Trigger signals for scenario 2. Major sovereign wealth funds begin publicly reducing exposure to U.S. treasuries. Oil and commodity contracts shift to non-dollar settlement at scale, not announcements, but real volume. U.S. Treasury auctions show stress, weak demand, or sharply rising yields. Dollar share declines accelerate to 3-5% annually. Scenario 3, stabilization. This is the scenario almost nobody talks about, because it doesn't sell. In this case, the U.S. adapts, not perfectly, not easily, but enough to stabilize the system. Through some combination of spending adjustments, revenue increases, policy shifts, or economic growth, possibly driven by technological productivity gains, AI, automation, innovation. This isn't optimism. It's acknowledging that systems can self-correct under pressure. Trigger signals for scenario 3, debt to GDP stabilizes or begins declining. Signs of political alignment around fiscal reform. Productivity, growth exceeds expectations. Interest rates normalize without triggering systemic stress. The goal here isn't to predict the future. The goal is to interpret it better as it unfolds. When you see headlines about BRICS or de-dollarization, you stop reacting emotionally and start asking, which scenario does this support? That question alone puts you ahead of 95% of people consuming this content. So what do you actually do with all of this? Let's move from theory to action, without exaggeration. First, diversification is reasonable, but precision matters. If you're heavily concentrated in dollar-denominated assets and your time horizon is long, diversification is logical. Not because collapse is imminent, but because concentration risk exists in every system, even dominant ones. A 10 to 20% allocation to international or non-dollar exposure isn't fear, it's risk management. Second, gold has a role, but it's not a miracle asset. Yes, gold has preserved purchasing power over centuries. That's historically true, but it's also volatile across shorter time frames. From 2011 to 2018, gold delivered negative real returns, 7 years where it underperformed significantly. If you bought near the 2011 peak, you waited nearly a decade just to break even in nominal terms. So no, gold is not a can't-lose trade. It's a hedge with strengths and limitations. Use it strategically, not emotionally. Third, avoid false certainty on both sides. Extreme narratives are usually selling something. Everything is collapsing is a product. Everything is fine forever is also a product. Reality sits in between. We are in a transition phase, and transitions are, by definition, uncertain. That discomfort? That's not a flaw, that's reality. Fourth, watch signals, not predictions. Predictions are static. Signals are dynamic. I've given you specific indicators for each scenario. Use them. Filter every headline through that lens. Is this noise, or is this structural change? This is how you move from passive consumer to active analyst. Let me close with what I actually believe, and where I could be wrong. I believe the dollar's relative dominance is declining. The data supports that. I believe the decline is more likely to be gradual than sudden. History and current conditions both point in that direction. I believe diversification across assets and geographies is rational for long-term positioning, but I do not believe anyone, including me, can precisely time this transition, or tell you exactly which asset will outperform, or predict the exact shape of the next system. Anyone claiming that level of certainty is either misinformed or selling you confidence as a product. Where might I be wrong? Maybe the system is more fragile than it appears. Maybe the transition accelerates unexpectedly. Maybe a catalyst emerges that no one is currently modeling. That's possible, which is exactly why the framework matters more than the prediction. Because if the timing changes, the framework still works. But if you rely only on predictions, you're lost the moment they fail. If this kind of analysis is useful, the kind that prioritizes clarity over fear, structure over hype, and frameworks over conclusions, then subscribe. Because that's what I'm building here. Not fear-based content, not blind optimism, but real analysis for people who want to think, not just react. In the next video, I'll break down the BRICS de-dollarization narrative in detail. What's real, what's exaggerated, and what actually matters. Thanks for thinking with me. I'll see you in the next one.